Hello and welcome to the official DeFiDive podcast. Today we're going to be talking about the state of the economy and what it means for crypto markets. You are hosted by two long-term crypto investors and now founders of DeFiDive, which is a price discovery platform that helps you make educated investment decisions into crypto. Most importantly, today we're going to be discussing the economy and what it means for the crypto markets. To recap what's happened this year, we've seen financial and crypto markets fall in response to higher inflation, which in turn has prompted the Federal Reserve to increase their interest rates. Most recently, we've seen US inflation hit 9.1%, and interest rates responded by going up a further 75 basis points to 2.5%. And as a result of all this turmoil that's happening with the economy, cost of living, and so on, GDP in America has recently fell 0.9% year over year. However, it seems like we've got to the point where financial markets had already priced this in, and all of the data I just described that happened in the past month was actually in line with expectations, and we've seen markets rally. So, for example, Bitcoin is up 21% month over month, Ethereum is up 54% month over month. So it seems like we're almost like at a inflection point in the financial market where we've seen a lot of prices come down in response to interest rates and inflation. The markets might have oversold, and now we've kind of seen a bit of a rebound where markets have realized they've oversold, and we've seen a short-lived but noticeable rally in recent weeks. Joe, what do you think to all of this chaos that's been going on this year?
Well, it's great to be back on the show, first of all. Great to be having a chat again about the state of the economy. And yeah, it's been quite a tumultuous journey since the beginning of the year. Markets have been up, markets have been down, markets have been all over the place, really. So, but yeah, what you identified was a lot of actions in the economy affecting the crypto space. So I've had this conversations many times this year. People jump straight in with what's happened to Bitcoin price, what's happened to Ethereum price, what's happened to my savings and investment without kind of zooming out and taking the bigger picture into consideration, which is, look, we're living in a post-COVID world. After the years of money printing, after the years of money supply has been diluted, now the central banks are putting up the interest rates. They're trying to take some of the money back out of the economy, just to let it fly under its own wings again instead of artificially being lifted up. And as a result, people are selling assets to pay off their loans. And of course, what are they going to do straight away? They're going to sell their most risky assets, which for most people is going to be their Bitcoin or Ethereum or cryptocurrencies. And they're going to be putting it into their house loans, their car loans, all of which are kind of going up in price as a result of the interest rates going up. So yeah, there's many knock-on effects about when something like this happens in the economy. So which is why it's great to be talking about it, I guess. Let's talk about the real impacts to investors. Let's talk about the real impacts to everybody's day-to-day lives and their mortgages, and let's talk about what it means for everyone, everyone in every part of the equation, right?
Yeah, what do you think the rest of the year has in store? Do you think the worst is over, or do you think the worst is yet to come?
So I'm hoping that the market has found its bottom around about a month or two ago. So this is when Bitcoin dipped under 20K. I believe Ethereum touched 1,300-ish, 1,200 or less.
As low as $900 off the top of my head.
Wow.
High
So yeah, but
800s.
yeah, so this was when all of those margin calls were triggered, but perhaps we'll touch on that later. But I think, I'm hoping that the market's found its bottom. Of course, nobody can predict the future, myself included. But certainly the view that I've seen within the cryptocurrency space is all of what we call the over leverage, all of the people who are borrowing against their portfolios, those deals have been unwound out of certainly the crypto economy. So hopefully, people with risky trading strategies who kind of depended on the price staying up and not dipping too much, all those kind of risky loans have been closed out, which hopefully means that any any upside in a current cryptocurrency price should be genuine long-term investor interest, which really kind of builds pace for the price to recover well.
Yeah, and I also am leaning towards the argument that the bottom is in, and I've been watching the financial markets and crypto markets very closely, as I always do, and since Bitcoin hit 18K, Ethereum $900, I was kind of thinking that the bottom is in, because financial markets, and by extension crypto, are always forward looking. So traders and investors are trying to predict what the future is going to be like, and prices adjust to expectations of what that future will be. So a lot of people, when Bitcoin was at 18K, were calling for 13K Bitcoin and more bloodshed in the markets, just on the basis of interest rates being here to stay, inflation being here to stay. But it's not actually the case. It's not like an on-off switch where if inflation is high, stocks and crypto are constantly falling, but rather the relationship isn't linear. So when interest rates first go up, the markets don't just react to interest rates going up to 1% or whatever. They react to the possibility that interest rates are going to go up to 1% and beyond. So they are forward looking and predicting the future conditions. So what that means is, for the markets to continually get worse, it doesn't matter if inflation stays or if high interest rates stay, but they need to continually get worse and worse. So I think there's a lot of evidence that the market has already bottomed, and what we've seen in the past month is markets realizing that all these financial assets were oversold, and we've seen a small rebound to the upside. Just almost like a reflex, where we've sold too much and some people have bought the dip and we've come back slightly higher. I think now is a good time to be thinking about whether we are flat, or if the economic conditions worsen. I think the biggest unknown is on grain exports. So I mentioned earlier that financial markets are forward looking, and they're trying to price in what the future looks like. And the biggest uncertainty that's actually hard for the markets to price in is grain and fertilizer exports from Ukraine. So the Ukraine and Eastern Europe exports a lot of agricultural products and fertilizer that the rest of the world depends on for food. And it's very difficult for anyone to predict just how much grain and how much fertilizer can be exported out of Ukraine, just given the volatile nature of the war, and the lack of information, and also the lack of guarantees. So last night, the first grain export left Ukraine since the war began, which was only possible because of a newly negotiated agreement between Russia and Ukraine that these exports should continue because the rest of the world depends so heavily on that region for food. However, there's no guarantees that this agreement can be upheld. That's just the unfortunate nature of being in a war. So I'm pretty confident that the bottom is in, but I think the number one risk that it's difficult for markets to price in is just the grain exports. And already grain exports have been slowed down already. So we're at a point where we need to play catch up, and the impact of that has not been fully felt. Same with energy prices. So we do know that energy prices have gone up, and the cost of living has gone up, and markets have responded to that, but we actually haven't fully felt the effects of higher energy prices during a winter. So that's another unknown. I think it's more easy for the markets to estimate what the energy bills are going to be like in the winter. So the main unknown really is grain exports. So I'm of the opinion that we're definitely not out of the woods yet, and it's worth keeping in mind that the rally that we've seen recently is just simply the markets preparing for the absolute worst, and interest rates, inflation, and GDP hit expectations rather than being worse than expected. So that's not really the basis for a long-term sustainable uptrend. So it seems like, potentially markets are going to be flat, if not down a bit, if we get a lot of economic knock-on effects from lower grain exports. So yeah,
Yeah. Yeah, I mean, there's a lot to unpack there, but I think it's worth reminding people that when I had an experience in finance, the major lesson that I learned was everything in finance, everything in banking, everything in asset pricing is all about risk. People think it's all about money, but in reality, it's all about risk. And what you identify there is war. War is a geopolitical risk. It's a political risk. And what it provides there is a lot of uncertainty. And when we try to equate things into the mathematics and the equations as to what should an asset be priced at, the one thing that makes things difficult to price is uncertainty. And so with a wide net of expectation on what could potentially happen if the war gets worse, if energy supply gets cut further from Russia, if grain exports don't happen, is that there is a lot of uncertainty on external factors that need to be calculated and priced into the economic movements. And yeah, as you quite rightly identify, the stock market, much like crypto, is a forward projecting pricing engine. People are trying to anticipate what a company could be worth in the future. But of course, if a war breaks out, if there's grain shortages, if the employees of that company are struggling to buy food because food and energy prices are going up, then it's going to impact the profits of the company. It's going to impact in multiple different ways. And that adds into the uncertainty of when you compare it to a stable economy where things are growing, where trade deals are being met, where energy supply is consistent and not fluctuating. But yeah, it's perhaps a perfect segue to talk later on in the show about what inflation, the other knock-on effect, which is inflation and wages not rising to keep up with inflation, and what that means for the wider economy as well and people's disposable income, which again has a knock-on effect to how much people can invest into alternative asset classes, especially high-risk ones like crypto.
Yeah, I mean, why don't we tell now what is the impact of higher inflation, and what does it mean for investing, and how have you personally tried to navigate this year with your portfolio and investing?
Yes, I mean, it's an interesting question because over the years, us as crypto people have always been advocates for preaching the gospel of, look, crypto is a great hedge against inflation, especially Bitcoin rate. So what that means is, what inflation basically means, if we break it down in a nutshell, is the price of everyday things becoming more expensive. And this is a mechanic which in economics, when you're running a country, when you're running a central bank, you realize that inflation is healthy, but what the healthy amount of inflation is for everything to be going up at a rate of about roughly 2% a year. Inflation is what governments try to track. So, and I do this mostly out of psychology, which is really interesting to learn about economics, actually. So it makes people feel like they're progressing in life if they're getting at least, say, for example, a 2% pay rise every year. They can see their numbers go up. Sure, things get slightly more expensive every year as well. There's a news recently saying that the cheeseburger was put up in price from what in the UK it was 99 pence, just under £1 to £1.20. But it was the first price rise in 8 or 9 years, I believe, which is kind of in line with inflation, though they're explaining. So yeah, this is a natural mechanic over time. And of course, the problems arise as they have since the beginning of the year because of a lot of these knock-on connected events, war, post-COVID recovery. We've entered a world where we're currently living in a space where people's salaries aren't rising fast enough to keep up with inflation, i.e., the price of living going up. And again, the interconnected nature of the world means that if energy prices go up, which they have been doing because Russia's been limiting its exports of energy, then your disposable income at the end of the day is going to go down as opposed to up. Even if your salary's going up, which has a very real effect on your spending power, and double impact if the food prices are also going up, because I believe the knock-on effects for the Ukraine grain exports or their lack of ability to export is the price of chicken feed is going up, which means the price of chickens themselves are going up, which is a main staple for most people. And so, yeah, but it's not just that as well. So when you combine that with the third impact of your interest rate payments going up, most people maintain mortgages or car loans, then that means you've got even less disposable income. So the economy is in a bit of a precarious place at the moment, and this is how inflation basically can affect day-to-day living. So yeah, you asked the question of how we protect against inflation. Back in the day, it was to invest in Bitcoin, which to be fair has done outperformed actually. So if you just take a narrow view of the last 6 months, of course it looks a little bit of a sad picture, a little bit of a sad state of affair. But if you zoom out to the bigger picture, anyone who's been invested in crypto for at least the last 3 or 4 years, if not longer, has been well protected against the most recent bits of inflation. How about yourself?
Yeah, I was gonna. I was tempted to interject for a second, but I wanted to let you carry on because I recently read where the 2% inflation target originated from, and the target actually comes from the Central Bank of New Zealand, and they were the first central bank to decide that they wanted to have a inflation target, and they kind of decided 2% because it sounds about right, and there's not actually not a lot of there's not actually a lot of science behind the reason why they chose 2%. And New Zealand were the first central bank to decide this inflation target, and it was something like back in the early 1900s. And then when other central banks decided they also wanted to have a inflation target, they just looked at New Zealand and said, oh, they've already decided 2% is a good number. And then more central banks decided to copy each other, and it got to the point where if you were to decide on any other number than 2% inflation, you were kind of going against the grain or popular opinion. So yeah, I don't know exactly how I should be using this information to allocate my portfolio, to be honest. But yeah, I thought it's just a fun fact that kind of shows that the people at the top don't necessarily always know what they're doing.
That's crazy, but that's super interesting fact to know. Actually, I always thought it was psychological. 2% is kind of what people have learned to expect these days, and I guess what you say is true, right? It's psychologically ingrained in all of us. Oh yeah, 2%. If it's more than 2%, we complain. If it's less than 2%, we'll also complain as well.
Yeah, yeah. I am optimistic that kind of whatever happens, crypto will still do well in the long term. And I think this is a really interesting scenario because it's the first time we've properly had inflation since the financial crisis. And since the financial crisis, developed nations have been able to have a very low interest rates, and that is preferable by governments because it means that they can borrow more with fewer downsides. So governments can borrow more because effectively the money is cheaper, and it also helps grow the economy because other people want to borrow more, and that in turn raises tax revenue, which gives the government more spending power. And there's a good argument that inflation has only been low during this period because Western nations have really benefited from the economic growth of China exporting cheap products to Western nations, which means that the prices paid in Western countries is low. And right now we're seeing the growth of China decline, and the benefits of China ramping up their production and lowering prices is coming to an end. And China have pretty much, reached the potential of the economies of scale they can provide. It's not realistic to keep expecting ever cheaper products coming out of China. We've kind of got to the point where it's as good as it gets. And compounding that, we also have a new trend where companies are taking part in onshoring. So previously, manufacturing was offshored to Asia, where it was cheaper, and because of supply chains being interrupted from COVID and so on, companies are now trying to bring back different parts of their manufacturing, which could mean that going forward, inflation is never as low as it once was, because we now are producing products in our own countries, and fundamentally these are going to cost more than Asia. And even if we were to stick with manufacturing in Asia, we're at the point where we can't really expect prices to keep getting cheaper and cheaper. So although a lot of this inflation is temporary, because we've got supply shocks from COVID and the war and excessive money printing during pandemic bailouts, it's very likely that actually inflation to some extent is here to stay. I don't think it's always going to be at 9%, but potentially we could see 3% or something for the foreseeable future. And it's going to be a really interesting decade, because in the previous decade, governments could get away with low interest rates because inflation was low, because products were cheap. And now we're potentially entering a different decade where products are no longer going to be cheap. And what this means is governments are potentially going to be forced to have interest rates a bit higher than they would like. So governments are going to be paying more interest payments on their debt, and their tax revenue is also going to be lower, because the economy isn't going to grow as fast as it could with low interest rates. So governments are going to be in a bit of a tricky position where their interest payments are rising and potentially their tax revenue is falling. And to bring this back to crypto, I think you can argue that crypto benefits from money printing and low interest rates, but I think crypto is designed to be an alternative monetary system, and these weaknesses show the need for a plan B or an alternative, or how smart contracts can automate parts of the economy and unlock productivity growth. So governments are in a real tricky position where they've got to pay higher interest on their debt, while at the same time tax revenue is falling because GDP will be falling. The only way for governments to simultaneously increase their tax revenue without actually increasing taxes, which will just hurt customers even more, is to grow productivity. And how do you grow productivity? It's a really difficult question. Most of the time it comes around from technological innovation. So improvements to farming, improvements to manufacturing. Then we had the internet, and looking forward, crypto is something that can unlock productivity. So I think we could actually see governments turning towards crypto as a source to unlock productivity in the economy and solve the problem of generating higher taxes without hurting the economy.
Yeah, I mean, So it's interesting you say there about the competitiveness of different countries, and especially the world trade is evolving, right? So in the last decade, we were very used to products being manufactured for super cheap in China, and then the Western world buying all these products and benefiting in their own economies from their cheap products. But over time, like China's been playing this little bit of a war of attrition, really. They know they've got, well, historically, they know they've always had cheaper labor. They've known for a long time that they can take advantage of that to create cheaper products. And as a result, the Western economies have been funneling, while products come out from the East, from China, what goes West is actually money, right? So actually, over time, you have this kind of balancing effect where the money's been traveling east, and as a result, the Western economies, their currencies have been slightly weakened. So certainly in the Eurozone, it's on parity with the US dollar now. The US dollar's not been doing great, and the British pound as well, especially when you compare it against some of the Southeast Asian countries' currencies. And this world is very, very connected. Once that happens, what you find is, yeah, as you identify quite rightly, it's less attractive for you to spend your, say, for example, US dollars if you're in America on buying products from Asia, because relatively speaking, they'll be getting slightly more expensive. And we've reached a tipping point now where America's realized, look, it can't rely on China for all of its cheap goods. We have to start manufacturing and depending on our own 2 feet, because globalization, as we saw in the last decade, was generally hugely beneficial to the world. But again, they've certainly come to a realization that there's a point in which we should depend on each other, especially when we're living in a environment of volatile politics. And to bring it back to crypto as you did, because all these currencies are interconnected and somewhat dependent on each other's for the movements, for the up and down movements, we should also give crypto credit where credit's due. So countries that haven't got their own currency management correct, who haven't sorted their own economies out, who have kind of done a bit of a bad job of it, or been a victim of their situations or politics or war, have benefited from the stability that crypto has had. So yeah, South America, El Salvador it's definitely worth a mention. And I believe was it Greece that was affected by hyperinflation as well. So
that's Turkey. And
Turkey, sorry, yeah.
Yeah. I read a bit about Turkey, and so Turkey has 80% inflation, and their president or prime minister, I don't know the exact word, their leader of the country believes that higher interest rates will cause inflation to rise further, which is actually kind of the opposite. So typically, like the Federal Reserve is doing, interest rates go up to try and combat inflation. But in Turkey, the leader of their country believes that higher interest rates will only make inflation worse. So because of this guy's lack of understanding of economics, the country is plunged into 80% inflation, and people in Turkey are buying everything they can to store their money in actual goods instead of hard currency. And they've been buying things like washing machines, anything really that they think is a store of value. And the government has imposed taxes on people wishing to buy US dollars, which shows why they're trying to buy washing machines rather than hold any currency. But it also kind of just shows how early we are with Bitcoin. It sounds like a huge cliche, but Bitcoin is an obvious place to store your money. And
yeah, absolutely. So I mean, it's the point in case is it's all relative, right? So although Bitcoin has dropped perhaps 60% or more in the last 6 months, if you compare that against hyperinflation of 80%, actually Bitcoin's a very attractive asset class, even though it's more volatile. And more governments and more countries and more citizens of countries in these places, El Salvador is another example where they had crazy hyperinflation, Venezuela as well, there were no shortages of stories, and even Ukraine, actually, to a large degree, there were no shortage of stories of people relying on, depending on, and really effectively using cryptocurrency as their safety net, which caught them quite well, actually. And so, sure, even though we might compare, say, a Western currency against an Eastern currency, the comparison is quite powerful when you compare Bitcoin against a country who has been experiencing hyperinflation, actually, because a legitimate way for people to really take hold of their own finances, to really kind of put themselves in a position which will benefit them in the long term, are the ones who are open-minded enough to look towards cryptocurrency and say, look, this is a legitimate asset class which we should consider. Sure, it comes with its risks. Sure, it's volatile as well. But as long as the risk is justified, well thought out, then it can work out, and it has worked out for many, many people.
Yeah, and interestingly, Turkey is suffering from 80% inflation. Bitcoin's only down 60% versus the US dollar from its peak, right? So if I need to do the exact math on this, but just off the top of my head, that would imply roughly 20% gain for Bitcoin versus the Turkish Libra, I believe it is. And
Yeah.
so in the long term, Bitcoin is working as a store of value against every currency. And then if you want to cherry pick date ranges, it's not worked as a store of inflation recently for the US, but it has in other countries, like you say.
Yeah. So, I mean, the interesting flip side of that is if you're living in a very economically stable place, actually, it's now's a great time to also, hold a bit of cash in your bank balance, actually, because with the interest rates going up, what that means is anybody who's cash rich will benefit from a higher interest rate from the bank as well. But yeah, do bear in mind and do remember that the bank does use the money that you deposit as their own. So not that I'm trying to put you off, but it's just a very real fact of how finance works these days. And of course, not all of us benefit from the fact from a country who's that's run very, very well, or whose economy is as stable as, say, for example, the United States. Because if you're in one of these jurisdictions, then cash-based savings is usually a very attractive option. So yeah, do bake that into your own personal financial management, and do consider holding cash as well as higher risk assets as well, especially during these times, because those individuals who have been sitting on cash for the last couple of months have also had additional alternative benefits. So I do get text messages once in a while saying, look, crypto's on a discount, I'm going to buy some now. So yeah, I don't know what your thoughts are about that, but yeah, certainly I've had a lot of people kind of try to speculate a little bit more during these times, and certainly these aren't the same people who have unfortunately got wrecked because they've only just learned about crypto 6 months ago, but perhaps people who have been involved a little bit longer, who do keep a little bit of cash on the side for limited time sales like these.
I mean, I kind of I mean, I personally, I do a bit of dollar cost average and a little bit of kind of calculated trades, and I'm pretty happy to have bought the dip around about like 20k Bitcoin, and same with Ethereum and other layer twos like Uniswap and Lido. Pretty happy to have done that, but I think it's not going to be plain sailing from here. The last economic scenario I wanted to touch on was there's one last scenario that people should be aware of, and I think this is unlikely, but it'd be very interesting if it happens. And there is a theory that the US government, they want to tackle inflation because they need to look good for future elections. And the trouble is when the US government increases interest rates, it increases the value of the US dollar, and it devalues other countries' currencies. And the US government is dependent on European countries and Japan to stop purchasing gas from Russia. And this means that the remaining supply of gas becomes more expensive because you've now got a lot of countries trying to buy a limited quantity of gas that doesn't come from Russia. And that means that the gas price goes up, and at the same time, the euro becomes worth less versus the dollar. So you've got double the expenses there. So if the US government wants the embargoes against Russia to continue, the US government may need to begin quantitative easing again. And they would do it in a way to print money and use that money to purchase foreign government bonds. This hasn't been done before, to my knowledge, but this is a potential plan to allow the US government to keep interest rates high, so they appear to be tackling inflation, but secretly in the background, they are still printing money. And that money is used to purchase foreign government bonds, which helps prop up the value of those currencies so that they can continue to buy expensive gas and ignore the cheaper gas from Russia. And if you are a believer that crypto benefits from money printing, then that is a plausible scenario in which the US government could start printing money again in the near future. So it's kind of stretching my limits of economics to say how likely that scenario is, but I at least know it's possible. So it's kind of just worth keeping in mind that, you know, even if we do have a long protracted war, there are still scenarios where crypto rises. You know, that's not the most important thing, but you know, we're just discussing crypto and stuff. Just something to be aware of.
Yeah, absolutely. So, I mean, this is, aside from all of our speculation about, what's happening in the global economy, the impacts of war on the energy market, are also, they're all interrelated, but it's also worth noting that, there are a lot of exciting things going on in the crypto space. And, originally one of the appeals for us as early investors in crypto was what it represents in terms of the global banking rails. So we're not just talking about the value of money at the minute, the price of money, but we're talking about, the technology behind what it can do, what it achieves, and what it can do for global trade in terms of, there's this term in the early days of crypto called accelerating monetary velocity. Are you familiar with that term? So it's where
speed of money transferring around.
Yeah, exactly. So generally in a healthy economy, money transfers hands very, very rapidly. And of course, one of the things that we were excited about was the fact that Bitcoin is and cryptocurrencies like Ethereum and the stable coins are decentralized money transfer networks. So they replace the rails of Visa, MasterCard, Amex, Swift, which are seen as legacy systems these days. And they're a lot more global in nature. They exist anywhere where the internet exists, as opposed to where you've got a Visa terminal, as opposed to where Swift has signed an agreement with a local bank. And the technological benefits are in this day and age worth more and more, where more transactions are going digital. Since COVID, we've seen a lot of people switch to contactless payment methods. Certainly in more developed countries, and even in a lot of Asian countries, people are using not just their touch payment credit cards, but using their mobile phones and QR codes. Certainly when I spend time living in Asia, I'm paying by scanning a QR code at the till, or the till cashier ladies scanning a QR code that's displayed on my phone to deduct the balance for my morning coffees. And it's hugely exciting to know that the world that we grew up in, certainly the world that was affected by the financial crisis before, and the way things were done then, is going to be hugely different to how we're going to conduct anything financial related in 5 or 10 years time. And these are the innovations which we're really invested in as long-term investors. So yeah, aside from the speculation on what's happening in the price due to war, we're very much advocates for the technological benefits which the cryptocurrency industry can bring to the world.
Yeah, absolutely. And I think the biggest technological discussion at the moment is the Ethereum merge. Do you want to explain what the merge is?
Sure. So the Ethereum merge is where Ethereum, I believe, in a current iteration is going to transition really excitingly from proof of work to proof of stake. So the way that most cryptocurrencies were originally invented was the nodes of the network, the computers that maintain this decentralized network, are people's essentially home computers. And what manages the security of these networks is the encryption of each block that's released every couple of minutes or every couple of seconds. Now, it just so happens that to encrypt something requires quite a lot of intensive, especially if you want to do it with a high degree of security, requires quite a lot of computing power. And that computing power, for the last 10 or so years, that encryption power has come from people's graphics cards, which just so happens to be quite energy intensive. Now in 2022, we realized that it's, for a long time, the cryptocurrency industry has realized that it's not a great long-term solution. It's not the best for the environment because you're trading off encryption power for essentially energy usage. And with the explosion of popularity of the cryptocurrency space, a lot of people were financially incentivized to run mining nodes to support the network, which means that energy costs to maintain the network became really significant. What's exciting about this is everyone from the environmental side to the core developers to everyday users in a space have been saying, where is our transition to proof of stake? Proof of stake basically requires enough cryptocurrency to be distributed widely enough around the place to the point where by just proving that you own a certain amount of cryptocurrency, you can do what's called staking. You can deposit it essentially on a node on a network and say, look, this is like my bond. You can trust my word that we're helping to secure the network by having my quite large financial deposit. I believe for Ethereum, it's 36 Ethereum, which is, at today's price, over 70,000 US dollars, right? I believe no, it's around 50,000, right? 50,000 US dollars. So to stake your funds to secure the network is a long-term solution that doesn't require energy-intensive mining equipment to maintain. And also, it's really clever because the economic game theory is because the cost of acting maliciously in the network is directly tied to how long your deposit stays there or how much of your deposit stays there, then there's an active disincentive for somebody to try to attack the network, which let's remember wasn't there to begin with. So we needed proof of work, but nowadays the transition to proof of stake is one that's a lot more healthier for the world and a future growth of Ethereum, which I'm personally hugely excited about. What's your thoughts on it?
Yeah, I'm really excited as well, and I'm a big fan of starting off with proof of work and then transitioning to proof of stake. And yeah, shout out to Vitalik, super smart guy, and really believe in his roadmap decisions. Proof of work. It's great at the start to have a fair token distribution as much as possible and reward the people who support the network and put their computing power to work to help secure the network. And then after a time, the network just grows so large that you're burning so much energy that you can transition to proof of stake. And you're at a point where the network has grown so much and so many people are contributing that proof of stake is fairer towards the proof of stake is fairer once you get outside that initial launch period, because you don't just have the 1% of the 1% earning huge interest rates on earning huge return on their Ethereum and then compounding inequality. Ethereum's at a point where 32 ETH is still quite a lot of you need 32 ETH to have your own node in order to stake Ethereum and earn interest on your Ethereum, which is quite a high barrier to entry, but it's still not as bad as doing proof of stake from the very start. And the super early adopters compound their returns so quickly at the beginning that anyone after them can never catch up. In theory, someone with no crypto could still buy 32 worth of ETH and immediately start staking and earn interest. So the going to proof of stake right now makes sense because To do it sooner would make the playing field very uneven. And interestingly as well, there are other services like Rocket Pool or Lido DAO that allow you to stake Ethereum even if you've got less than 32 Ethereum. You basically deposit your Ethereum with them. They pull together enough funds and they pay out your share of the staking rewards depending on how much Ethereum you've contributed. They come with their own risks, and you are dependent on the success of Rocket Pool and Lido. I haven't given them any of my Ethereum, for example, but it probably would be fine, but not financial advice.
But staking pools, those are called, yes, where you can pull together with a collective of people to reach that 32 Ethereum, and it levels the playing field. It makes things fairer for everyone to access.
Yeah, I'm pretty pleased with Lido's price action, to be honest. I'm happy with a couple of Ethereum merge related plays I did. So going into this bear market, I went 100% into Bitcoin because I knew previously that Bitcoin does better in bear markets, and I got it. I sold all of my Ethereum for Bitcoin when the exchange rate was at 0.07, and then I saw the price drop to 0.05, so Ethereum losing value to Bitcoin. And then after our last podcast, I saw that Ethereum was looking really cheap on a few different technical indicators, and we also had confirmation that the merge was going to happen in September. So I then rebought the Ethereum back with my Bitcoin, and then the exchange rate went from 0.05 to 0.07. So all in all,
incredible. Incredible.
All in all, I have got 25% more Ethereum than if I just did nothing. So I'm pretty happy with that play. And I also was doing a lot of research into layer 2s and other tokens to invest in after our last call, because a lot of these got hammered in the bear market, and I wanted to pick up a few gems that were unfairly sold. And I bought Lido at 50 cents, and it's gone up to like 250 250-ish at its peak, and it's at 1.96 at the moment. So that's a pretty nice way to triple or quadruple your money.
Only a 400% return. Nothing interesting here. Move on.
Yeah, I mean, obviously, just like sensible amounts of money. So my background hasn't been upgraded since the last podcast, but stuff like that really is very much welcome, and people are optimistic about the Ethereum price in itself. So we've already seen Ethereum beat Bitcoin by 25% over the past month, and people are optimistic that this will improve further, because the new issuance of Ethereum is going to fall from 4% per year to under 1% per year. So people are calling this people are comparing the merge to a triple halving, where a halving is where every 4 years the amount of Bitcoin that's produced gets cut in half, and Ethereum is potentially going to see a triple halving, where you halve the amount of Ethereum being produced and then you halve it again. So the halving is historically marked the start of a new bull run for Bitcoin, and people are kind of excited that the same could happen with Ethereum. There's a few dark clouds on the horizon for Ethereum. Like the SEC recently announced that the only cryptocurrency that is a commodity is Bitcoin. Everything else is a security. So maybe Ethereum is going to get some unfavorable regulation soon. Maybe not. What are your thoughts for post-merge Ethereum price?
Yeah, it's really interesting to hear about your plays, because we've maintained for a very long time that I certainly have always been an advocate for showing that Bitcoin is pretty much seen as the gold or the gold standard of the space, right? So if anything's traded through cryptocurrency, certainly in the first 5 or 6 years of the invention of cryptocurrency, everybody by default bought Bitcoin first. So they went from the on-ramp, which is from fiat currency to Bitcoin, and then only from Bitcoin to the other cryptocurrencies. So in terms of monetary velocity, the amount of trading that goes through the asset class, Bitcoin is king. And certainly your thesis of converting everything back to Bitcoin when the crypto economy is going crazy is certainly one that paid off for you. So I guess we should start calling you Mr. Time the Dip here. has done well on that one. So, but yeah, your other plays, I think it's also worth noting that I've been a long-term advocate for always investing in crypto infrastructure. So whatever represents, say, the growth or the future potential of, a crypto innovation or a utility. So a couple of that I want to kind of highlight that you mentioned earlier, the layer 2 solutions. So Matic, I think we gave that an honorary mention a couple of podcasts ago. That dipped quite heavily, I believe, if we follow the price action on a DeFiDive website, and it's recovered really quite nicely. Actually, I believe this morning I checked on the website, it said it was up to 90 cents again. So layer 2 solution, of course, is to explain in a nutshell what it is it's a way of the Ethereum network processing a lot more transactions than it can currently process. I believe the current transaction throughput is about 12 to 15 transactions per second, which astonishingly Ethereum has grown enormously from that base. But a layer 2 solution offloads a lot of the transaction overhead to a separate chain, of which Matic handles. And it increases the monetary velocity, which helps the crypto economy grow. This is up until the future upgrades of Ethereum, where they increase the transaction throughput, I believe, up to 100,000 transactions per second and beyond, which is hugely exciting, but it's on a future roadmap. But again, these are examples of technological innovations which we like to invest in as well. Honorary mention goes to Chainlink as well. So price oracles, in a nutshell, what Chainlink does is it enables blockchains to know what's happening outside there in the world. So what's happening with all the crypto prices, any financial data that comes into the cryptocurrency space has to be brought in through what's called oracles, which are essentially API connections that fuel any blockchain solution or any smart contract, which is really, really important. So all of these plays generally tend to do quite well in the space. I've personally not been actively trading in this space because I tend to do a long-term portfolio risk management view. I always make sure my infrastructure investments are placed correctly. Luckily, I dodged a bullet by not having any exposure to the stable coins, Luna, or Luna 2 for that matter, or UST, because a lot of people unfortunately got led down the rabbit hole of thinking that 20% returns were sustainable. In hindsight, it's kind of obvious for us all, but there again, I'm not going to blame people for getting caught up in that, because genuinely a lot of these mechanics have worked in the past, but unfortunately there were exploits. The mathematical modeling of the risk modeling of their price peg was wrong, so that crashed the token. But my investment approach in these last couple of months has just been to stay diversified, to try to reduce the risk and consolidate my portfolio on the higher risk crypto plays. So certainly the smaller coins and the riskier, say, NFT investments that we made towards the tail end of last year. Certainly been looking to consolidate those and bring them back into cryptocurrencies and just hold on to those blue chip NFTs. The NFTs, which are the OGs of the space, the ones that should maintain a good future value. But it's just a way of me cutting out noise from my day-to-day workflow. So, for example, if I was to do a lot of research, it would involve me opening up a lot of tabs to keep an eye on my portfolio. But as a way of avoiding that noise, to consolidate your portfolio is a great way to help you focus on the investment plays that are really going to pay dividends in the future.
Yeah, I'm really glad that we spoke last time about layer twos, because there's such a strong argument that as more transactions happen on layer twos, that's where the money's going to flow. That's where there's going to be further upside potential in the price. And I did due diligence on maybe like 10, 15 or so different like crypto tokens after our last podcast, and I decided to not invest in any other alternative layer ones when I was looking to buy the dip, and instead it was just all about Bitcoin, Ethereum, and layer twos. And I'm just going to share my screen so that we can look at some of the price charts on DeFiDive. So we'll start off with Chainlink, potentially a less exciting price action. You can see Chainlink, okay, right?
Yeah, I can.
Good. Yeah. So so like you said, Chainlink is a price oracle. So in Ethereum, we have smart contracts that will perform actions when other conditions are met. So, for example, in the future, you could sell a house if someone deposits $1 million into your bank account, and automatically the deed of ownership is transferred over, for example. And in that hypothetical scenario, Chainlink would potentially verify that your bank account has genuinely received $1 million, and someone's not trying to scam the smart contract to get ownership of the deed. So Chainlink could be really valuable. And again, this has been pretty much flat over the past month, but we saw an all-time high of $35. So potentially quite a bit of upside if bull market resumes. And then one I wanted to call out that you didn't mention, and this is probably the favorite one that I found, Uniswap. Of course, I was aware of Uniswap before, but I decided to actually do some proper due diligence on them. And it's a pretty incredible company, in my opinion. So for starters, we've got an all-time high price of 38 of actually it's $44. I'm checking my notes. All-time high price of $44, but recently in September it was $30, and we're currently just under $8. And what Uniswap is, it is a decentralized exchange that is built on Ethereum that allows people to exchange one crypto for another crypto without relying on any centralized company or any individuals. And it's the largest decentralized exchange, so it's well positioned to capture trading volumes that happen in crypto. The company is backed by A16Z, and currently the token holders don't earn any share of Uniswap profits, but one day this could be enabled. So on top of potential price growth, Uniswap could effectively pay a dividend back to its shareholders. And I was looking at their finances, and the revenue of Uniswap is growing. The revenue very recently has dipped during this bear market, only because crypto prices have dipped. But if you even out crypto prices versus the dollar, trading volumes on Uniswap are growing, and they trade at a price to sales ratio of 5.7. So companies are typically valued as a multiple of their yearly earnings, and tech companies will typically be valued anywhere between 30 or 100 price to earnings ratio. Tesla has recently been valued at 100x their price to earnings ratio. So for me, I was looking at all of this and I was seeing that forget about crypto, just knowing that this is a company backed by A16Z that is growing its revenue and trades at 5.7 sales to price to sales ratio, that's insane. So when I bought the dip, right, I bought at $5 here. I missed the absolute bottom around here, and then I bought again at $5 here. You can't time it perfectly, but I was looking at all of that, and I was thinking Uniswap is the fastest way for me to retire. I only put in like 2% of my portfolio, so I was keeping these numbers sensible. But I kind of feel like I'll look back and think, if I went 50% of portfolio, I'll probably be retired very quickly. But you can make.
So wait, let's hold up here. You're giving yourself a hard time for entering $4.50, and the price is currently $7.90. So yeah, no need to sweat. Only a 50% increase in what, 2 months or so.
Yeah. I mean that's
crazy.
Oh yeah, I'm pretty happy with that. And well, I think what's good is that I'm not trying to shill Uniswap, but if the all-time high price is $44 and we're currently at $8, there's still quite a lot of upside. And fundamentally, if you just think about Uniswap as a generic company, we know that the company's revenue is growing, but they're only valued at 5.7 price to sales ratio. That was valued at around $5. So potentially this is a 15 price to sales ratio. That is still really cheap.
That's incredible. No, I'd love to just have a segment on Uniswap as well. Actually, I'd love to just weigh in on it, because actually one thing that really inspires me is perhaps we should do a talking segment or a podcast episode on companies within the crypto space, Uniswap being one, because we love to talk about tokens, we love to talk about the cryptocurrencies, but we don't often talk about the companies within the space or what they do. So if you don't mind loading up that screen once again, actually, I'd love to just show the audience how I do my research on something like Uniswap, because if you just press the DeFi tab over there, what you were mentioning earlier is, and this is the way I love to use this website to research what investments are great. We know from our involvement in the cryptocurrency space that the largest companies within crypto, I'm not talking about tokens or token value, but the largest companies in the crypto space and the most important ones so far have by far been exchanges, right? The bridging mechanism between the fiat world and the crypto world. So in 2022, we're talking Binance. Back in the day, we used to talk Mt. Gox, then it was Bitfinex, and it was Bitstamp. But now all the eyes are focused not just on Binance, but in the future, you need to consider that it's not going to be a Binance future because decentralized exchanges are becoming more popular. The trading volumes are going from centralized exchanges to decentralized exchanges. And sure, we've got to acknowledge that centralized exchanges like Binance play a hugely important role in the economy because they need to be the fiat on-ramps. But in reality, a lot of crypto natives are looking towards Uniswap and thinking to themselves, look, we don't need to go through a third party or intermediary to change a crypto to crypto token pair. We can just go and do some research on what DeFi or what decentralized finance options we get and do what we call an atomic swap. So straight from our own MetaMask wallet within our own browser, from say one crypto asset to another one. And if we look at this DeFi leaderboard page, the way I like to use this page is I like to look at the total value locked, which is a leading indicator for how trusted the decentralized finance solution is. And you can see there that Uniswap is the top of the DEX category. So if you press the category filter on the right for me and filter against DEXs, and you'll see that Uniswap is the largest decentralized exchange, which is hugely exciting. If you hover your mouse over where it says chain and multi-chain, we can also see that it's on multiple different chains as well. So Uniswap has really solidified its position in the decentralized company space, decentralized finance companies, as almost like the Google of search engines for decentralized exchanges. It's the largest by far. It's got the leading position, and for a tech company, usually the leading the technology leader is one that builds a protective moat around their business model, because they're so far ahead. All the users start to trust that solution and that solution alone. And certainly about what we know about the way that the crypto economy works is certainly exchanges, the more popular the exchange, or in this case the decentralized exchange, the better the pricing for the end clients as well. So yeah, I think it's a great investment. I think certainly if we do our research like this, and pick the most popular categories that yield great numbers, that have been affirmed by not just the users but by the top investors in the world as well, and it has great numbers, as you've identified in your own personal research, it has, then I think you can't go wrong. So yeah, hugely excited to see what the future brings for Uniswap. And yeah, let's definitely do a segment on some of these companies in the space. I'd love to talk about Binance, Coinbase, and how they compare against the decentralized options as well in the future.
Yeah, absolutely. And the one thing that I would add to what you said is I think a lot of people buy the Binance token because they think that they will now own a part of Binance, and that's not correct. BNB is a token that is used on the Binance Smart Chain, which is effectively a competitor to Ethereum. It's like its own layer one blockchain, and arguably it's not very good because it's quite centralized. It doesn't have as much traction, and yeah, you should be very aware that if you buy BNB, you are not owning any part of Binance. You are owning a token for the Binance Smart Chain. So you should only buy that token if you are optimistic about the Binance Smart Chain. I'm personally not. So if you want to own a crypto exchange, you should probably buy Uniswap, in all honesty.
Yeah,
Not financial advice, but
agreed.
Uniswap is the largest DEX, as we can see here, and if you own the token, you own at least governance rights of Uniswap.
Yeah, great point.
And yeah, I think the other one I just wanted to briefly touch upon is Lido DAO, just to illustrate the crazy growth of Lido. So the thesis behind owning this token was that after the Ethereum merge, more people will want to stake their crypto, and Lido is a service that allows you to stake Ethereum without owning 32 Ethereum, and it pulls together people's Ethereum so you can deposit a smaller amount, which if it all works is a great service. It's a really great use case, and you can kind of see that just after the merge was announced, we've gone from 50 cents all the way up to 240 cents. So that's pretty crazy. And I believe, don't have much more data than this on how far it can go, but I believe off the top of my head, yep, I got it here. Lido has an all-time high of $10. So even still at $2, if it goes up to its all-time high, that's a 5x increase. And this is a good example of a asymmetric bet where you could potentially invest a small amount of money, and if it fails, you lose a small amount of money, but if it succeeds, you win a big amount of money. So Lido DAO is a good example of a asymmetric bet. And then Polygon, you mentioned earlier. Again, I don't know the exact reasons for Polygon pumping. I think it's just been part of the overall layer 2 interest that's grown in recent months. And Polygon have also announced that they are launching Ethereum virtual machines so that smart contracts can execute on their layer 2. And it seems like this is going to be a key pillar for Ethereum to scale. So we will potentially see more and more transactions relying on Polygon. So we've seen crazy price growth here as well. And the last topic I'd like to bring us to is NFTs, and we'll have a look at looks in a minute. But to provide some context with NFTs, the market is doing okay. I think one thing that is a red flag for NFTs is that trading volumes fell off a cliff in June. So trading volumes were down 73% month on month in dollars. It's worth knowing that the price of Ethereum also fell 31% month over month in dollars as well. But that also means there's about a 40% real drop in trading volumes on OpenSea. Having said that, the number of monthly active users on OpenSwap is steady. So monthly active users has been at 1.7 million pretty much every month throughout this year. And it was only recently that we saw a drop off in trading volumes, which potentially could rebound given that we still have the same number of monthly active users on OpenSea. And I think going into this bear market, there was an expectation that NFTs would be the equivalent of initial coin offerings that were part of the 2017 bubble. And by all measures, NFTs haven't popped. We haven't really seen any price appreciation of the staples like Bored Apes and CryptoPunks, but given that they've had such a large run up, the fact that they haven't just fallen down to the floor should probably be considered a success. How are you feeling about the NFT market?
Yeah, so I've always been a long-term advocate for the NFT space, not necessarily for any specific piece of artwork, but because of the technological innovation which they represent. Really, NFTs are a way in the future where digital contracts are going to be digitized and traded and sent and settled as tokens on a blockchain. They're absolutely ingrained with the way that smart contracts are built and work as well. So whenever you have to trade, something of financial value, say for example, Ethereum, a token like Ethereum, Bitcoin, or a stable coin, to buy something of value, say for example, in the future, it's going to be a house represented by a blockchain house deed, then NFTs are going to be key for those transactions to become successful. My entire thesis on investing into the early artistic NFTs were, look, if this is a moment where NFTs are invented, then it's going to be worth investing in some of the larger, more popular, original, innovative products as well. So those are what I call the blue chip NFTs. So certainly the groundbreakers like Bored Apes, CryptoPunks certainly set the precedent for the entire NFT space to explode. And OpenSea, you mentioned earlier, which is the largest marketplace for NFTs, also recently attracted a huge amount of venture capital funding from Silicon Valley as well, solidifying its place in cryptocurrency infrastructure future, much like Uniswap for decentralized exchanges. So I'm feeling generally positive about space. Certainly the price movements are in line with my expectation. Of course, we didn't anticipate what the price movement was going to be, but I certainly feel like the price action is very rational to what's happening. People are pulling their money out of higher risk assets. And if we look at cryptocurrency as a whole, as a space as a whole, NFT assets are seen as the more excess end of the market. So they're not necessary for your everyday survival. And, if you did have to sell something that you own just because you needed the money, for most people, it made sense to sell their NFTs as opposed to their long-term crypto holdings, as opposed to their stable coins, or even their everyday assets as well. Say they've got a car at home, it's certainly more less painful for them to sell, say, an NFT that they may not really enjoy all that much, as opposed to a car to get access to that money. So yeah, when you look at it in terms of, what assets represent higher risk, the price movement's dropping more significantly than the rest of the cryptocurrency space. And the fact that these NFTs have to be bought by a cryptocurrency like most popularly Ethereum, the price dropping slightly more than the cryptocurrency it's traded for certainly is in line with what I'd expect. Longer term, I'd say, do still consider some of the blue chip NFTs as good long-term investments. But certainly our view is to always only ever buy NFTs if you actually like and appreciate the artwork and want to keep it for a long time, and not to speculate with them unless you're that way inclined with a huge risk appetite. So that's my general thoughts. So trying to speculate with it, buy blue chips, hold for a long term, and that's certainly what I'm doing in my personal portfolio, which is holding its own fairly well because of that.
Yeah, some good advice. I think if you are going to hold a NFT, ideally it should be a blue chip, and ideally you should be buying early. It's easier said than done. I missed out on the growth of Bored Apes and CryptoPunks and so on. It entirely depends on your net worth whether you should buy a Bored Ape at these prices. It wouldn't make sense for me to buy a blue chip NFT at these prices. Like, my portfolio would be not very well balanced, I think. But yeah, if you're a early NFT investor, I think there's no problem in keep on holding if you've got the risk appetite for it, and then if you have got the net worth to buy a blue chip, then you can also do so if it makes sense that it's going to be part of your 2% of your portfolio that's allocated to asymmetric bets, risky investments. Then NFTs can fit that bill. I've been trying to refine my NFT thesis over the past year, and I feel like I have actually come to my conclusion on NFTs since our last podcast. And I kind of came to the conclusion that I don't think that image-based NFTs should have any value, and I'll explain why. And the logic behind investing in NFTs generally comes from the idea that people thought smartphones were going to be very popular, so they buy Apple stock. People think that online shopping is going to become very big, so they buy Amazon stock. People see that electric cars are potentially the future, so they buy Tesla stock. And the trap I think people fall into is they see that NFTs will potentially be a big part of the future, therefore I should also buy an NFT, right? The trouble is that NFTs can become a huge part of the economy and financial system, but that doesn't mean your picture of a monkey is going to be worth a lot. Amazon became a very valuable company because they were capturing a large market share of online shopping. With NFTs, the dependence on them and the value they provide isn't going to necessarily flow back into the value of an image. So I think I am optimistic about NFTs, but I would prefer to invest in NFT infrastructure rather than actual NFTs. I do own a few small NFTs, so I'm not just a complete skeptic, but I think potentially the real hard use cases is going to be when NFTs are powering smart contracts, what NFTs are being executed as part of smart contracts. And I think the exchanges upon which NFTs are traded will also be very valuable as well.
Yeah, no, it's an interesting thesis, one that I wouldn't entirely disagree with. I am a bit more of an advocate when it comes to holding the blue chips, because I do think personally that some of the infrastructure that's going to be built off the back of it is going to be first built off of the image-based NFTs. But yeah, quite rightly so. I think 90% of the market can be represented by the fact that, look, these are literally just images. They're a copy of a 10,000 drop project. And ultimately, there's not much artistic licensing or rights that justifies, say, $1 million projects, net worth, and certainly some of them are harder to justify than others, where there's a really huge, strong sense of community, where there's a huge amount of desire. I do see from an for art's sake perspective, where there's a huge amount of demand for a limited ownership number of, say, Bored Apes. So I do understand from an economic perspective, and certainly that's my thesis of why some of the most popular historical blue chip projects are going to be worth the while. But I'm really excited for that bridge you mentioned, where smart contracts can be used alongside NFTs, and the use case which the most excited about is what I call collateralized lending. So where you can deposit, say, a 50 Ethereum Bored Ape into a smart contract and borrow against it, almost like you're taking out a mortgage against a house. So your collateral is your artwork, and certainly the banking industry does that currently. If you're lucky enough to, say, own a Picasso, there are banks out there in London who will lock your Picasso, verify your Picasso, they'll lock it up in their safe, and they'll lend you a couple £100,000 against that, given that your Picasso is verified as authentic and actually worth a bit of money. Then the banks will lend against it. And it's a great way for those with a little bit of wealth to increase their asset holdings without taking too much risk. And a bank will acknowledge these risks. So this mechanic, if we realize, actually happens all around the current economy. It happens every time we buy a car with a car loan. The car acts as the deposit, the guarantee itself, the collateral itself, and your loan is what you pay off with the interest rate every month. Same with a mortgage. So the reason why I'm so excited about NFTs and NFT smart contracts is in the future that we're predicting, the future that we're investing in, the decentralized finance future, this loan mechanic is going to be represented quite a lot by NFT-based smart contracts. So, the home is going to be represented by an NFT in itself, and the lending is going to be handled through cryptocurrency deposits and a smart contract. But I think the gateway to get to that world is going to be where it's first developed for something like a Bored Ape. So first of all, we're going to see these smart contract solutions where we can deposit, a Bored Ape owner can deposit their Bored Ape, borrow some cryptocurrency against it, and pay the lender of the cryptocurrency a small amount of interest. And if you don't pay that interest, then the collateral, which is the Bored Ape, will get transferred to the lender, which is really interesting mechanic, but one which I think is going to be really representative of the decentralized finance future.
Yeah, interesting points. I think you're probably right that the image-based NFTs will be effectively a test bed for NFT infrastructure, which, if it can work for these image-based NFTs, it can potentially work for houses represented by NFTs. And undoubtedly, there is so much potential for NFTs to improve the world. If you buy or sell a house, the whole process is incredibly slow and inefficient. NFTs can really help automate parts of the purchase, so you have fewer intermediaries involved, lower cost, quicker transactions time. Huge use case. Ticket sales for music concerts and sports events as well. Huge use case to allow people to resell their tickets fairly, crack down on counterfeits, and also allow musicians and people to profit from secondhand ticket sales as well. Another great use case. And on the counterfeit goods topic as well, a few luxury watch companies are starting to issue NFTs with watch sales so that it can reassure future buyers that the watch is a genuine. And if the owner doesn't have, the NFT with the watch to prove it's authentic, then potentially it's a fake. Whereas if they have the original NFT, and you can look on the blockchain to see that that the NFT came from the watch manufacturer, it gives you a lot more reassurance that the watch is more likely to be real. So yeah, undoubtedly, NFTs are going to be part of the future. I think they'll be part of the future, but you'll never see them. It's all going to be behind the scenes, which is how it should be. People won't know that they're dealing with an NFT. They'll just know that their house sale is happening 10 times faster than it used to be, which is going to be a brilliant use case for crypto. We're pretty much at an hour and a half, which has been it's been a great conversation. Are there any closing comments you'd like to make?
Yeah, so in this space, in this economy, people certainly who have invested recently are a little bit more panicked than those who have been invested in the long term. But the advice, has always remained true. Again, not financial advice, but if you're going to manage a crypto portfolio, don't invest more than you can afford to lose. Do consider methods like dollar cost averaging, so you're not beholden to a single price which you're invested in. And yeah, stick with the main staples if you're worried or concerned about what to invest in. Bitcoin, Ethereum is certainly what I generally tend to recommend. And only if you acknowledge that you've got the risk appetite within you, then you should branch out and do a lot more research on a platform like ours, like DeFiDive, to find out what to invest in. But other than that, yeah, I'm really excited to see the innovations come to play. It's a lot of exciting stuff we've talked about that are coming up soon, like the Ethereum merger we're looking forward to. Other than that, let's just keep tabs on our news and just stay safe out there.
Yeah, very nicely put. If you want to watch the next podcast episode, make sure to subscribe and to check the latest prices of all the tokens and cryptos we've discussed today. Make sure to head over to defidive.com. Thank you for watching.